I would rather see the Fed eliminate paying interest on reserves, and that's what an audit, I definitely would audit the Fed. That's what an audit would reveal. I'd like to know how much of that $500 billion has gone to the top 5 largest U.S. banks. I'd like to know how much of that $500 billion has gone to foreign-owned banks.
You're watching Silver News Daily. Subscribe for more.
The global financial system is standing on a knife's edge, and almost nobody sees it coming. What if I told you that everything you've been told about inflation by the Federal Reserve is a lie? Dr. Judy Shelton says the Fed's narrative isn't just wrong, it's dangerously misleading. And the consequences? A full-blown collapse of the fiat currency system. Imagine a meltdown so severe that global markets spiral into chaos, leaving investors scrambling for safe havens. But here's the twist. While the masses panic, gold and silver are set to skyrocket, offering a once-in-a-generation opportunity. History shows that when fiat fails, silver doesn't just rise, it explodes. We're talking about a financial reset that could dwarf anything we've seen before. The question is, are you ready to see through the lies and discover why silver could be your best shot at surviving the coming collapse? Stay with me, because what you're about to hear will change the way you see the markets forever.
I would hate to malign individuals with intent to deceive, but I feel very comfortable in pointing out how unreliable a lot of government statistics have turned out to be, how often revisions to employment numbers and growth numbers completely change the earlier understanding of what had been happening in the economy. And I would say, why not allow at least Congress, where you have elected officials, to weigh in on whether they think it's appropriate to deliberately debase the value of our money unit. And I heard you cite earlier the 1792 law on currencies, and that was based on Thomas Jefferson's notes on the establishment of a money unit for the United States. And he felt that if we make the dollar our unit, we have to then say with precision what a dollar is. And the founders thought that it was extremely important to have stable money with integrity that people could trust, that it would remain a certain value, and that was defined in terms of a specific weight of gold or silver. And they hoped that would become a universal standard and certainly a permanent measure. It's Article 1, Section 8 of the Constitution that gives Congress the power to regulate the money, and it's in the same sentence that gives Congress the power to define official weights and measures, because money was meant to be a measure and not something subject to variance going forward. So I would like to recapture that concept, and it seems to me perfectly reasonable to ask the American people, you think we should have zero inflation? Does that fit with your idea of stable prices? Or do you like that purchasing power is intentionally reduced at least 2% per year by the Fed's monetary policy decisions, so that the dollar over let's say 100 years goes to being worth at 2% inflation about 5 cents, or 3% inflation, well, I might have to reverse that, 13 cents and 5 cents at 3%. So that was once brought up at a Federal Reserve meeting, and one of the members of the Federal Open Market Committee, who was the head of a Federal Reserve District Bank, Jerry Jordan, said, I don't think we should be asking people whether they want the dollar to depreciate 2% a year or 3% a year. He said, I think we should be asking them, do you think it should depreciate at all? Why can't a dollar be worth $1 in 100 years or 50 years? Why can't it be as good as gold? And that goes back to that founding principle.
Dr. Judy Shelton isn't mincing
the value
words.
of our currency.
She claims the Fed's so-called solutions are nothing more than dangerous deceptions. Let's break it down. Since the 2008 financial crisis, U.S. banks have hoarded excess reserves at unprecedented levels, ballooning from a mere 9% to a staggering 2,063% of required reserves. Why? Because the Fed made it profitable to do so by paying interest on these reserves. This policy, presented as a stabilizing measure, actually encouraged banks to withhold liquidity from the economy. Instead of fueling growth, these reserves became a ticking time bomb, waiting for the moment confidence in the system cracks. Dr. Shelton argues that these actions masked the true effects of inflation. By manipulating interest rates and injecting liquidity at will, the Fed created an illusion of control. But underneath, the foundation was crumbling. With minimal opportunities for alternative investments and skyrocketing unemployment during the crisis years, the economy became addicted to easy money. And addiction always comes at a cost. As inflation pressures mount and the Fed struggles to justify its policies, the cracks are starting to show. The excess reserves that once seemed like a buffer now threaten to flood the market with liquidity at the worst possible time. If this happens, inflation could spiral out of control, pushing the US dollar toward collapse. But here's where things get even more interesting. Dr. Shelton believes this collapse isn't just a risk, it's inevitable. And when fiat currencies start to fall, history tells us there's only one place investors will run. The stage is set, the Fed's narrative is unraveling, and the fallout could spark the greatest silver rally in history.
And docked in terms of their actual earnings that reflected their purchasing power because inflation was higher than the amount of the raise. And to shore up this argument, she cited a survey of workers. This had been done by her husband, who was a very preeminent economist. He still is, George Akerlof. And the survey asked workers, would you be happy to get a 2% raise even if inflation was 2%? And just over 50% of the workers said yes, which they took to mean so they would count it as a gain, even though it really wasn't. But then she added in that they gave the same survey to economists, and the way she phrased it, and this is captured in the transcript, she said, you'll be pleased to know that when we put the same survey to economists and said, would you be gratified if you got a 2% raise, but inflation was 2%, the majority said no, they would not. And the transcript records laughter around the table. And I saw that as an example of hubris, thinking we, the economists, are so much smarter than the average employee, someone who works for their wages. But I also thought it was just plain false. We've certainly seen that unions are more than happy to bargain for much higher future wages to compensate for what they expect to be higher future inflation. So this was discussed around the table, and the next day, Chair Greenspan and the vice chair said, I don't think we should publicly say that we're going to target 2% or 3% inflation because Congress might fault us for doing that. And I think on the same logic that maybe you and I are saying, because it seems like a deliberate deception. And it was even suggested by McDonough, the vice chair, that this is something that really should be decided by the American people, maybe even subjected to a vote, that should your central bank, the Federal Reserve, deliberately target a decline of 2% in the purchasing power of the dollar as a matter of policy. And then they decided not to put that to an American vote, not to put it to Congress, but they did not publicly say they had an inflation target until, I believe it was 2012, under the new chair, Ben Bernanke.
The collapse of fiat currencies isn't some distant doomsday scenario. It's unfolding right before our eyes. Let's take a closer look at why this meltdown is not only inevitable but accelerating. For decades, governments worldwide have relied on the illusion of endless money printing. Fiat currencies, backed by nothing but trust in central banks, have been inflated beyond recognition. The US dollar, once a symbol of strength, is now teetering on the brink. Trillions of dollars have been pumped into the system to prop up markets, fund deficits, and bail out financial institutions. But trust? That's running out fast. Debt levels are soaring to historic highs. Global economies are drowning in obligations that can only be serviced through further devaluation of their currencies. Every dollar printed chips away at purchasing power, making the collapse a self-fulfilling prophecy. The warning signs are flashing everywhere. Rising inflation rates, slowing growth, and growing skepticism in global markets. Investors are beginning to question how much longer this charade can continue. Confidence, the last thread holding fiat systems together, is fraying fast. And when confidence collapses, the fall is swift and brutal. We've seen it before: hyperinflation in Venezuela, the Argentine peso crisis, and Zimbabwe's infamous currency collapse. In each case, the pattern was the same: overconfidence in fiat, unchecked money printing, and then a rapid flight to hard assets. This time, the stakes are higher. The dollar's role as the world's reserve currency means that its collapse could trigger a global financial shockwave. When the US dollar falls, it won't fall alone. Currencies across the globe will tumble, igniting panic in international markets. But while fiat currencies crumble, history shows us a clear path forward. In times of monetary collapse, the masses turn to tangible stores of value: gold and, crucially, silver. Silver's unique position as both a monetary metal and an industrial asset means its potential for explosive gains far exceeds that of gold. As the global financial system teeters on the brink, silver stands ready to surge. The question isn't if, it's when. And that moment is coming faster than anyone expects.
Than less than the agreed price. And that is something that's referred to as an abomination. And that's why I feel that honest money is what citizens, especially in a self-governing country, based on that American idea, people such as ourselves as American citizens have the right to demand that from government. And when the Federal Reserve deliberately targets not stable prices, as their mandate says, literally, but rather stable inflation, it becomes then a deliberate policy on the part of our government, which has entrusted this function of securing the monetary integrity of the US dollar as our legal tender. It sets up the Federal Reserve to deliberately debase purchasing power. That is, if the Fed hits its 2% inflation target and pats itself on the back, something it hasn't done for going on 4 years, it has not hit 2%. But if it did, it would congratulate itself. Now think over 10 years at 2% annual inflation, the purchasing power of money you have earned or saved has lost 20%. I consider that expropriation of your purchasing power, because in addition to serving as a medium of exchange and a unit of account that fosters trust on both sides of any transaction, money is supposed to serve as a store of value. And for a lot of people, saving money over 10 or 20 years or putting it into a house and then having the value of the house redenominated in diminished dollars is highly unfair and fundamentally dishonest.
When fiat currencies crumble, the world turns to what's real: gold and silver. But this time, silver isn't just playing second fiddle. It's gearing up for a performance that could leave gold in the dust. Let's talk history. Every time fiat money falters, silver emerges as the underdog turned champion. In 1980, silver rocketed from under $6 to nearly $50 an ounce in just months. The catalyst? Inflation fears and waning confidence in the US dollar. Fast forward to 2011, amid economic turmoil and debt crises, silver surged from $9 to almost $50 again, outpacing gold's percentage gains. These weren't random spikes, they were silver's response to a broken monetary system. But here's the twist: today's setup is even more explosive. While gold has already started making moves, silver remains grossly undervalued. The gold-silver ratio, a key metric showing how many ounces of silver it takes to buy 1 ounce of gold, remains at historically extreme levels. Every time this ratio corrects, silver doesn't just catch up, it overcompensates, delivering returns that stun the market. History is preparing to repeat itself, but with a new catalyst: unprecedented industrial demand. Silver isn't just money, it's technology, energy, and progress. The world's transition to green energy has made silver indispensable. Solar panels, electric vehicles, and 5G networks all rely heavily on silver's unique properties. Unlike gold, which sits in vaults, silver is consumed, creating a supply-demand dynamic that could send prices soaring. The solar industry alone accounts for nearly 20% of global silver demand, and that number is only climbing. As governments pour billions into renewable energy, silver's industrial role becomes impossible to ignore. And here's where it gets critical. Silver's supply side is tightening. Mining production is declining, and recycling can't keep up. Demand is surging while supply shrinks, a recipe for a massive price spike. Add to this the inevitable investor demand during fiat collapses, and you have a perfect storm. Silver's dual role as an industrial metal and a monetary hedge makes it the ultimate asset in the coming economic reset. Gold may get the headlines, but silver is where the real action will be. The question is, will you be positioned before the surge begins?
You can redeem your instrument in either the face value amount or a pre-specified amount of gold, let's say an ounce. And that would be, for the bondholder, the equivalent of a U.S. Treasury security and a futures option on gold. I think such an instrument would be oversubscribed and would end up being a very efficient and inexpensive way for the U.S. government to borrow. But even more importantly, this would serve as a barometer. We could start to look at the yield on a gold-backed treasury offering compared to a traditional treasury offering. And that would show aggregate expectations about the future purchasing power of the dollar, because it would reflect what a premium bondholders would pay to know that they would have the option to be repaid in gold, which for a lot of people is even better than the CPI, because they look at a loss of dollar purchasing power with gold as kind of a surrogate for the real economy and for commodities in general, and not just a number compiled by the Bureau of Labor Statistics. So I think that would be very worthy and apropos as we enter this golden age under President Trump. It seems an ideal time to launch such an initiative and have it out there and say, we want fiscal policy to do better. We want to move toward a balanced budget. We want monetary policy to move toward stable prices and not just continual inflation, even at a low rate. We don't want that steady erosion of our legal tender. I think it could be held up as an ideal. And to our trading partners, if you start to measure the variance between the dollar's value in terms of gold compared to these other currencies, you get a very clear-cut picture.
Silver's time in the spotlight is coming, and the market signals are undeniable. Let's break down why silver is poised to not just follow gold, but to outperform it dramatically. The gold-silver ratio is flashing a historic buy signal. Right now, it sits at levels that, in the past, have triggered some of silver's most explosive rallies. For perspective, when the ratio soars above 80, silver historically surges as it catches up to gold. And today, it's well above that threshold. The last 2 times this ratio corrected, silver didn't just rise, it rocketed. In 1980, the ratio collapsed from over 80 to under 20, sparking silver's jump from $6 to nearly 50. In 2011, a similar reversion pushed silver to almost 50 again. Each time, silver gains outpaced gold by a wide margin. But this isn't just about ratios and historical trends. The behavior of institutional investors reveals the bigger picture. Hedge funds and major financial institutions are quietly positioning themselves, reducing short positions and increasing physical silver holdings. For years, big banks suppressed silver prices through massive shorting strategies. But cracks in that system are appearing. When these shorts inevitably unwind, whether through forced liquidations or market pressure, a short squeeze could send silver prices into overdrive. We've seen this dynamic in other markets, but silver's global liquidity and industrial relevance mean the impact could be far more explosive. Then there's the looming supply squeeze. Global silver deficits are no longer projections. They're here. For 4 consecutive years, silver demand has outstripped supply. Industrial demand continues to rise, yet mining output struggles to keep pace. Unlike gold, silver is consumed in manufacturing processes, meaning less of it returns to the market. This creates a structural supply crunch that can only be resolved by higher prices, and those higher prices could come fast. Investor sentiment is another critical factor. Retail investors are increasingly waking up to silver's potential. The recent surge in silver coin and bar purchases indicates a growing distrust in fiat currencies and a shift toward tangible assets. As this sentiment spreads, momentum could build rapidly. Silver doesn't climb slowly when the breakout begins. It slingshots, leaving latecomers in the dust. The market is sending clear signals. The gold-silver ratio, institutional movements, and tightening supply all point in one direction. Silver is preparing for a breakout that could eclipse even its historic runs. The question isn't whether silver will rise, it's how fast and how far. And with the perfect storm brewing, the answer might shock even the most seasoned investors.
Not paying banks money to keep them from lending it elsewhere. Some of that money, it's $3.2 trillion currently, that's a lot of money sitting at the Fed, would surely go into other treasury securities that would bring down those 5 and 10-year rates, the benchmark rates, and the longer-term rates that affect mortgages. But some of it, even better, would be loaned to the private sector. The Fed created those high reserve accounts, those high cash balances by purchasing government debt, but then it keeps them corralled by paying this excessive high rate of interest. And I think that has messed up the yield curve and caused this weird anomaly where the rate the Fed pays is 4.4, and yet we see high rates for the long term, the 10-year, instead of having a normal yield curve. You see that banks, I think, speculate. Banks are more interested in engaging with the Fed and listening to the latest statement. And if the Fed starts talking about being more hawkish, then they think, well, let's just keep the money sitting in cash. Why lock it in for these longer 5 or 10 or 20 or 30-year Treasury securities? Why lock it in if the Fed's going to keep paying us to do nothing, to keep it in cash? We don't even have to hire a loan officer. We just have to worry about a compliance officer. And so the examiners stay happy at the Fed. I think that's a mistake. I would rather see the Fed eliminate paying interest on reserves. And that's what an audit, I definitely would audit the Fed. That's what an audit would reveal. I'd like to know how much of that $500 billion has gone to the top 5 largest U.S. banks. I'd like to know how much of that $500 billion has gone to foreign-owned banks, because they also benefit from this. And we see that banks belonging to the European Union or other rivals in Asia, they can park their cash also at our Fed. And when their own central banks are paying much lower rates as their target interest rates, they're more than happy to pick up this bonus, which is, in the end, coming out of Treasury, which means it's being paid by taxpayers. Because if the money was not being paid out, and right now the Fed is even losing money as it pays that interest to banks, it would otherwise go back to Treasury, and it would increase those funds available to taxpayers.
The surge towards silver isn't happening in isolation. There's a silent revolution brewing in the currency markets, and it's signaling something much bigger. The rise of alternative currencies, especially gold-backed options, reveals a growing distrust in fiat systems. Just look at Florida's latest move, the launch of the Florida Goldback series. This isn't just a collector's item. It's a sign of where things are headed. Florida, the largest state yet to embrace goldbacks, is sending a message. People are waking up to the reality that fiat money, backed by nothing, is vulnerable. And when confidence fades, sound money becomes the only logical choice. Goldbacks represent more than just currency. They embody the concept of intrinsic value. Each note contains pure gold, a tangible asset immune to the whims of central banks. But here's the twist. While gold-backed currencies like these are gaining traction, silver remains the undervalued giant in the room. Silver's historical role as money, combined with its industrial utility, makes it uniquely positioned to benefit as this shift accelerates. When trust in fiat systems erodes, people don't just turn to gold, they turn to silver for its affordability and explosive upside potential. Florida's move could spark a domino effect. Other states are watching closely, and as confidence in the dollar continues to wane, we could see more regions adopting similar alternatives. But why does this matter for silver? Because it signals a cultural and economic pivot toward tangible value. The broader adoption of gold-backed notes highlights the growing appeal of real assets in everyday transactions. As this trend gains momentum, the demand for silver, both as a monetary asset and an industrial commodity, will surge. Moreover, the introduction of goldbacks shows that the idea of sound money isn't just for investors anymore. It's entering the mainstream. And as the concept spreads, silver's unique position becomes clearer. Unlike gold, silver is accessible. It's the people's money, the bridge between everyday transactions and long-term wealth preservation. With central banks continuing to inflate currencies and public trust eroding, silver stands to gain more than just investment flows. It could reclaim its role as real money. The launch of the Florida Goldback is a warning shot, a sign that the monetary landscape is shifting. Silver's affordability, industrial relevance, and historical role in commerce make it the ideal asset for this new era. The question is, will you recognize this shift before the masses catch on? Because when they do, silver won't just rise, it will explode.
I remember a year after Alan Greenspan had left, after being the head of the world's most powerful central bank, the Federal Reserve, for close to 18 years, he was asked exactly that question on air on Fox Business. Why do we even need a central bank? David Asman asked him as the moderator. And I suppose you could have expected the chairman of the Fed, prior chairman, to just say ridiculous question. Obviously, the U.S. enjoys soft power around the world. We have the dominant reserve currency that gives us some geopolitical advantages. And because of our depth in financial markets, there are many arguments in favor of having the dominant central bank in the world. However, Greenspan's response, I think, is very intriguing. He said it was an interesting question. And he said, we live in a democratic society, so we have decided to have fiat money, and that's Latin. It basically means it's money because I say so. It's I declare, so be it. And Greenspan went on to say, if you're going to have fiat money provided by government, it can't work in the same way as, he said, if you have either a gold standard or a currency board where there's a finite quantity of money, where it's limited. If you don't have some kind of limit in creating money and you just have an ever-growing money supply, he said, history has shown you will have inflation with very deleterious effects. And he ended up saying, I think I'm quoting, there are some of us, myself included, Greenspan said, who think we did very well under the international gold standard from 1880 to 1913. And even as chairman, and I had the privilege of meeting with him pretty regularly when he was chairman and after he had been chairman, and he remained intellectually consistent with views saying when we had a gold standard, we did have disturbances, but they were limited and they self-corrected. Versus when you're controlling the money supply, and we're really talking about not just for the United States, but as Robert Mundell, a Nobel Prize winner, who I greatly admire, always said, the only closed economy is the world economy. So you have spillover effects from whatever our Federal Reserve does I think that
The global market reckoning is here, and silver is set to take center stage. Let's connect the dots. The Federal Reserve's inflation lies have laid the groundwork for a fiat currency collapse. Decades of reckless money printing, manipulated interest rates, and inflated debt have pushed the financial system to the brink. The warning signs? They're everywhere. Excess reserves ballooning to unprecedented levels, inflation, eating away at purchasing power, and a growing global realization that fiat money is failing. And when fiat collapses, history is clear. Real assets take the crown. But this time, silver isn't just following gold's lead. It's primed to outperform it. We've seen the pattern before. In 1980 and 2011, silver didn't just climb. It surged past gold in percentage gains, driven by fear, inflation, and collapsing confidence in paper money. Now, with industrial demand at record highs, a supply crunch tightening the market, and the gold-silver ratio screaming for a correction, silver is set for an explosive breakout. This isn't speculation, it's market mechanics. And the rise of alternative currencies like the Florida Goldback signals a seismic shift. The public is waking up. They want sound money, assets with intrinsic value. Gold has its place, but silver's affordability, accessibility, and industrial necessity make it the standout opportunity. As trust in fiat erodes, silver stands ready to reclaim its historical role as money for the people. The pieces are in place. The Fed's narrative is unraveling. Fiat currencies are teetering. Alternative money is gaining traction. And silver? Silver is about to surge in a way that could redefine wealth in the years ahead. The window of opportunity is closing fast. The question is, will you be watching from the sidelines? Signs, or will you be positioned before the breakout? If you found this discussion insightful, don't forget to subscribe for more updates on silver's explosive future. And remember, this is not financial advice. Always speak to a professional before making any financial decisions.